Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Luke Laretive, Ben Richards, how you going, fellas?
Rasky.
It's always good to chat reporting season. Who better to speak to than the two of you? Today, we're going to bring some winners and losers to the table. It is in the thick of reporting season. By the time folks hear this, it's a Saturday, which means that we've had 1 week, which is typically the slower week for the month.
Yeah,
so
last 2 weeks is the real money time.
That's when you guys get no sleep. So today we're going to talk about a few companies, and I'm also just going to pick apart your process for how you deal with a month like this. If anyone's listening or watching and you want the guys and I to have a chat about a company that you might follow, we will, in this episode, talk about some companies that are coming up with their results, and you may be a shareholder and want to pick the brains of these two gents. So use the usual channels to write in and send us your feedback or your questions.
Or just book a meeting with the Rask Linky link and you can catch up with Ben and I directly.
Oh, yes. Get the portfolio review from the messes here. That's great. So, fellas, I hear a lot of different approaches to reporting season, and obviously it gets quite busy, like you guys being very active in small, mid-caps here in Australia. There's a lot of companies reporting. How do you deal with that?
Yeah, I think it's the key is to do your work ahead of time or as much as you can. We keep kind of notes on all of our portfolio companies so that each time they report or come out with a bit of news flow, we can kind of add to our existing database. And I guess using tools as well to try and automate and simplify the whole reporting season process. Like we use FactSet, which tells you a summary of each result and whether it's in line or beaten or missed consensus and guidance. So things like that are really useful just to kind of streamline the process.
Not just but like it shows you, where all the estimates are, like by broker, so you can kind of get it by analyst. You can kind of, quickly skim transcripts, compare transcripts. Like having the right tools is pretty important. And I think, without having something like FactSet, I don't really know what you're like. I don't really think you're kind of even in the game.
Yeah.
I think also just like having experience of, listen to the same management team, followed by the same analyst. You get to know who's telling you porkies, who's kind of being conservative versus too aggressive in their forecasts. Like one company we'll probably talk about more in the later in the show, but it's something that I think Luke's got a pretty good handle on where management is positioning the market. So you'll jump on the call at 11 o'clock with the analysts and brokers, and generally stocks can move after that call or even during that call, even if it's in a different direction to what it opened at 10 a.m. So yeah, I think a combination of everything. There's probably no one size fits all.
Just like anything, like you eventually, like you do something enough, you start to recognize patterns, and you pay close attention to things. You can recognize patterns in investor behavior. You can recognize patterns in the way stocks trade. You can recognize patterns in a depth screen in the bid offer spread. So I'm not saying it's all science or it's all art, but probably some sort of combination of the two. But definitely, experience, I think, and being a practitioner kind of helps.
Do you guys, I know you share research as well, right? Like you do your free articles and all those types of things across the internet. But do you guys use any type of tool internally? Like, is it FactSet that you use to communicate results, or is it just a bit more ad hoc? I'm just curious how you might store that information, or how where you put your research.
Yeah, it's all in FactSet, and then anything we write internally just goes in our team notes folder. So that's sort of is the FactSet's really the repository of everyone else's info, and then kind of our internal database is our repository of our own info, and yeah, we try and figure it out from there.
And the good thing about something like FactSet is you can set up custom alerts, for anything, whether literally like if a valuation falls below a certain threshold or relative to its average, or
you can set up technical stuff. We've got stuff set up for golden crosses or for death crosses, momentum indicator, like anything, right? So it's pretty hard to miss stuff when you're set up to catch everything, I suppose, and it helps you get through, the noise and the signals a lot easier.
Because you can really be objective if you say, I look at this under $10 stock price, and then it gets under $10, ding, and then, what are you doing? Either something's materially changed or you were lying to yourself in the beginning with that thesis. So, yeah.
Yeah, that's a good way to think about it. Do you guys, one final question on this, do you guys always listen to management calls or listen to or read the transcripts? Like, is that like something that you would do for every portfolio?
Not every.
No?
I mean, if it's a portfolio company, we'd try to listen to the call, definitely.
Yeah. I don't read. I don't like sit on a call. I'm listening to calls at 10 o'clock. Catching up on the calls all day. Like, I think
if something moves,
if something really tell me, yeah, I'll be like, Ben, get on the call. Like, it's as a general comment, you go through the results first and be like, well, what don't I understand? And then, like, if you can't go on a call and predict what 4 of the 5 relevant, because a lot of the calls, the questions are just completely irrelevant. So, and they're deliberately, set up that way. So, is a call really valuable to have management read slides and pre-prepared remarks? Sorta, but like not really. What's more relevant is when you can get them in a room 2 weeks later and say to them and ask them hard questions and then watch them squirm in their seat and see which direction they squirm and how they respond to those hard questions, and maybe questions that you're not willing to ask in a public forum. We were talking this morning. There's lots of things, like we've got lots of investment ideas. We were looking at writing an article for current what we're doing this morning, but I was like, I don't really want to tell people about that yet. I don't really want people to know that thesis yet. I'm not quite ready to share that. I think sometimes with questions, like I don't really want to tell every other analyst in the market how I've got some little bit of nuanced information and I want management to answer that in a public call that gets recorded. It's sort of stupid. So,
which means on the flip side, the questions that do get asked are just
bullshit depreciation, trying to figure out
your knowledge.
Yeah. And often it's more about, the questions that get asked are more advertising your brand.
Yeah.
In that market, Citi, here's a question from Citigroup, or here's a question from, Macquarie. Like, it's not really, of any use. So I think it's good. I think if you're trying to get across a story, or it's the first, second time you've heard it. But if we don't know what the RPM Global Management team are going to say on the RPM Global call in August, like there's something wrong.
Yeah,
we should know that already. Like it's not. It shouldn't be anything. It should be of zero interest to us. And yeah, we should be focused on things that are a little bit more strategic and long term and adding value.
I wanted to cover up on 3 big news headlines, and I'll be quick with the first one or 2 because they're not as relevant to some of the discussion we're going to have today. But the third one definitely is, which is the biggest news item of the week, which is that like the media was out reporting that the ASX had fallen by blah, 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 blah since insert the most recent date they could draw the Excel chart back to. But 2 pieces of news that came out in the US was an antitrust case that was lost by Google in effect that would actually be a good thing for Google because they won't have to pay Apple for its monopoly in search. And the other thing was Buffett selling more of Apple's shares, which I think was just aired on a day when the market was extremely volatile, and then people thought that he had timed the market perfectly or something like this. I don't know how much you guys pay attention to the news out of the US or globally.
Yeah, you pay attention to it. I don't know. Do you?
Oh, I mean, where possible. I mean, there's so much information bombarding the inbox every morning, but
Who gives who gives a shit what Warren Buffett's doing realistically? Like, does anyone even listen to that guy anymore?
the disciples.
Like, you know, like
Ooh.
it's, you know, what some old bloke, you know, this, who cares? Like, I just don't actually think that it's that relevant. Like, he's a big investor, he's got a heap of money. I think he had a huge position in Apple. I think he's halved that position. I think that's probably just good portfolio management. And it's probably got bugger all to do with Apple. And probably a lot more to do with Warren being 170 and you know, starting to think about his own mortality.
Well, it's quite interesting because you're right. He didn't sell out completely. The position that Berkshire had amassed in Apple was enormous, and I think that's one of the kind of the key points. Is like it's not all or nothing when you've got that much money, and he's got to do something with it, right? So, huge amount of cash. The Google one's quite interesting. It reminded me of like early Microsoft days when they used to have Internet Explorer. I know you guys are PC users, so
easy.
I won't say too much, but I remember in the early days, like Microsoft came pre-installed with Internet Explorer, and that was a huge antitrust case back in the day, and ultimately concluded with nothing really happening. But there was obviously the biggest piece of news, and the thing that's probably on most people's minds from this week is we opened, Monday, and the ASX was hammered. I think in your update that you did for Rask, your written update, which I'll put in the show notes, it wasn't just Monday. Like the Friday before was also quite brutal for a lot of stocks.
Climate Channel was out on Friday, so yeah, that's what kind of spooked everyone.
Yeah, walk us through it, Luke.
So whenever stuff like this happens, it's usually like it's two coincident factors or three coincident factors. There's never one thing that normally like kind of causes something like this. It's always when two things happen together. And the two things that happened together here is we saw weak employment data for, in short, that's just a short version, but weak employment data out of the US, which was kind of counter to the strong GDP and strong retail sales data we've seen recently. And I'm talking recently like 4 or 5 weeks ago. And so that sort of spooked everyone that the US was, going into recession and the Fed hadn't cut rates fast enough and blah, blah, blah. And then coincident to that, the Bank of Japan increased interest rates from 0 to 0.25%, which is the first time they've been above 0 since 2007. So that's a big problem for hedge funds because hedge funds have been on this, what's called a carry trade. That's what everyone's writing about, but that's just what it's called for a long time, where essentially you go to Japan, you got US dollars, you convert them to Japanese yen, so that's demand, and then you borrow Japanese yen, convert it back to US dollars, and then go and invest in US assets or higher return assets. So think US stocks, US bonds, whatever, right? But that creates excess demand for US dollars relative to Japanese yen because obviously you're borrowing yen, selling it, and then it also creates excess demand for US stocks and other US higher return assets. So when the cost of that money changes, people went, shit, it's the first time in a long time that's happened. Maybe this is going to be a hiking cycle in Japan. We need to unwind this trade. And so how do you unwind it? Well, you sell US dollars, you sell your US dollar denominated assets, you go back to Japan and you return the money that you've borrowed. So so the Japanese yen spiked, Japanese equities went nuts and then dropped and had a lot of volatility over 2 or 3 days. And then and our markets and the US markets and the other places where returns have been higher sold off heavily and all the safe haven assets went up. So bond yields fell, to 3.6. I think they're back at 3.8 now, but there or thereabouts. They're low, really low relative to where they were in May at 4.6 or 4.7%. So 5% on shorter term rates. So yeah, that's kind of been what's happening. We have these two coincident things. The Japanese thing is probably only relevant for your plans to go on a 5-star skiing holiday in January to Japan. The end's going to be high. It's going to be a bit more expensive for you, Owen, to go over there.
I would like to go back
on the private jet to Japan. So that's a shame for you. Outside of that, it's really nothing to worry about. It's a, sort of hedge fund speculator type sort of problem, and let the gurus in America sort that out. It's got nothing to do with anyone else. I think and as for the 2 data points in the US, I don't think they're particularly relevant in the context of the rest of the data. It was only 6 weeks ago we were talking about that the RBA and the Fed need to raise rates because inflation wasn't where it needs to be, and GDP growth was too high, and unemployment wasn't low enough. So market's being a bit bipolar as far as I can see. And yeah, for us, it's just a really good opportunity to buy stocks, and thankfully we had some money to do that. So very pleased with the last few days, and hopefully sets us up for another good month.
Can we start with some of these companies here locally? Can we talk about probably the one that caught people off guard the most was the miss? I don't know which of you want to take that. Maybe, Ben, if you set the scene for us, man.
So Audinate, AD8, the stock code. They had some numbers out this morning.
Well, context. It was $24.
It was, yeah. I think it was $23 when we wrote it up on
LiveWire,
which is very rare that you call the exact top of the market.
But we did.
Yeah. So, yeah, it was $24, and the company had just reported really strong first half numbers. Revenue was up, profit was way up given the operating leverage in the business. It's got momentum, like it's got a good story. It's, doing
growth, like
digital sound transmission. Yeah, it's all the buzzwords. It's actually an interesting company, is the first thing I'll preface it with. But the valuation just got way out of hand, in my opinion. I remember reading a broker note saying that the implied compound annual growth rate of profit was something like 30% for 8 or 10 years, which is not only, highly optimistic, but basically no companies
ever achieve that.
Maybe one of Owen's favourites, Pro Medicus, is the only one that's even in the ballpark. But
we'll talk about that in a minute.
Yeah. So anyway, it kind of got to a valuation that was, I think, a bit too hot. And then their numbers were actually okay. It was more the outlook statement for next year, where they said
terrible.
Audinate expects to generate US dollar gross profit marginally lower than FY24, and there will be a decline in revenue in FY25 before a return to anticipated growth and more predictable order patterns in FY26. So, if gross profit is going to be marginally lower than FY24 and revenue also down, that operating leverage, which I mentioned a minute ago, in reverse. So to get to that valuation, it's even harder. So the stock was smashed over 30%.
It's down 45% roughly in the last 3 trading days.
Yeah.
Wow.
Just continuing
and already down, like it went from
$8 a share.
Yeah, it went from 24 to 12, and I think it's now like 8. Just so it's rough thumb suck. I don't have a chart in front of me, but maybe you can put a chart up in the edit. But
and you look at the consensus numbers, and you're still expecting profits to double in FY26 from FY25. So
there you go, 25 to 15, and then 15 to 8.
Yeah, it's an ugly looking.
That is just lovely, lovely stuff.
It's pretty wild.
It's so, like, I think Ben hit the nail on the head here. And aside from us standing on the soapbox telling everyone how clever we are, it's a really good lesson that, like, knowing a qualitative story and understanding that a company is growing its sales and it's growing its profit and it's got a high ROE and all of this good stuff that everyone always bangs on about is just totally insufficient. Because at the end of the day, that is literally what I think, maybe it wasn't Warren Buffett, it was someone else talked about, swimming. No, you don't know who's swimming naked until the tide goes out. And you are literally swimming naked because you've got no concept of valuation and you've got no concept of value. And unfortunately, that is what I find doing a bunch of these portfolio reviews for you and the other work that I'm doing. with the sort of retail investor community for the first time in my career, to be honest. I'm learning is that they can all tell me a good story about why to buy a stock. They've got no concept of how to sell it.
Right.
And unfortunately, investing is a two-part trade.
How do we look for these situations in the future? 3 things in my mind stand out with Audinate that you can look for in any company. CEO sold a bunch of shares in the last 12 months, like a big whack of shares, even maybe before they raised capital as well.
Before it was bad.
Which is a bit of a red flag. Second is if you went through their last result, which looked really strong, you can see that they actually benefited from a big backlog of orders, particularly in the year or two since COVID when there was chip shortages, etc. And
so like Bruce, so like your revenue's juiced up by sort of a period of single time exceptionalism, for lack of a better word.
Yep.
And I think it had just gone into the index as well. So you'd seen this massive flood of passive buying as it went into the ASX 200.
Correct.
Which is the most, commonly followed. A lot of ETFs track it. So yeah, that's another thing that can kind of artificially.
It's not that liquid if you talk like insto kind of liquid, sure, retail, whatever, but like from an insto liquidity perspective, it's not that liquid. So look, I think any company so if you can identify a company that's going to be included in the index before it's included in the index and before it's announced to be included in the index, you can often make money. The converse is also true. Once it is included in the index, often these companies come undone after a big run up because of exact same issue. So it's whether which side of the liquidity are you on? Are you on the sort of the pre-liquidity or the post-liquidity side? And I think post-liquidity can be very problematic, but Ben's made 3, write those down. You know what I mean? There's 3 really good things on why Audinate was to us pretty obvious, when to everyone else it looked like the best since sliced bread.
Would you buy it today?
Hell no.
Still expensive?
It's actually still expensive. It's actually it's still expensive. And I had a quick look at this the other day before we haven't even talked about this yet, but I think it's worth $5. That's kind of what I'd buy. So I'd buy on a margin of safety to $5. So probably like $4, I think is probably what I'd pay for it. I don't think it's a bad business, like Ben said, kind of niche-y moat type thing. Not sure how big the addressable market is, not sure,
That's the key. Like I remember looking at it a couple of years ago, when the interest rate hike cycle sort of set in, share price pulled back. It was around that $5 or $6 range. I thought it could be interesting. Did some work on it, and that was the thing I struggled with the most. That the addressable market, it was a good time to buy.
Yeah.
But I just couldn't quite get my head around the addressable market. Like even if you assume they're going to take most of it, which is it's already pretty much priced in. Yeah. So I think it's just about getting comfortable with that. But yeah, I agree around that $5.
Yeah, I think under $5, it's when it's cheap, and then how cheap do you want it to make sure that you don't stuff up? And I would say it'd be low 4s. That'd be my kind of gut feel for it. Now I haven't done that's 1 hour of me sniffing around.
Yeah,
I think there's probably if we were going to actually buy it between now and then, we'd probably do a lot more work than me having a little thumb suck. But that's kind of my gut feel for it.
Yeah, fair enough. So that was a miss, and probably it would be the biggest miss of the week, at least in terms of investors' favorite types of companies to talk about. On the other side of the ledger, like what companies, I know it's early days, but what other companies so far have caught your attention for good reason, let's say?
Did you want to talk about maybe Credit Corp?
No, you do. You're more entertaining than me.
I'll talk about one of mine then. Pointsbet on PBH. It's been around for a few years, and it's probably burnt a few investors out there. It had a big US business that, once they legalized sports betting in the US, in a lot of states, Pointsbet spent a bucket load of money trying to get some market share there. Shaquille O'Neal's on every billboard going around, and they did get some customers, but it was pretty heavily loss-making, and they spent a lot of money to acquire those customers. So it's not a business that we would ordinarily be interested in, until they recently sold that US business for $300 or
333 Aussie.
333 Aussie million.
Yep.
And returned the capital to investors in a two tranche, $1 and then a 39 cents capital return. So the share price, although it looks like it's gone down heavily twice, it's actually just a capital return back into investors' pockets. And then what's left over with the business now is Australian business and Canadian business. So it's mainly Australia, and both of those are pretty much in a similar situation. And that chart, Owen, is why I think one of the reasons why we like it, because it looks terrible. It looks to most investors at a surface level, having not done any work, that it's just an easy void.
Yeah. When in fact, if you pull up a total return chart, which you won't be able to do on the illustrious Yahoo Finance, but if you had one, which we can send you one, you'll see it to line up and to the right.
Because the Australian business has been going really well.
Australian business kicking ass.
It's growing 20-30 turnover, 20%.
Yeah.
Net wins growing, and it's hitting that critical inflection point that we look for in small caps land, which is sustainable profitability. And it's doing so while growing the top line at, Australians say growing at 20%, but even Canada, which is a lot more nascent, is growing at 50% in the market's growing. Under
early doors.
Early doors.
It's only like 1/10 the size of the Aussie business, but it's growing quick and growing double the rate the Aussie business is.
Yeah.
But I think, look, all in all, you've got a nice, fully, like from a technology and a product delivery perspective, it's a business that's done all the investing. It's done all the lifting. There's not a lot of sort of R&D or product marketing you need to continue with beyond, maintaining your position in the market. So if they can continue to grow 20% from here, it doesn't take too many quarters of decent growth for them to start looking really profitable, at which point it will be, I don't know, we think it's worth 70, 80% more than the current share price. So it's from our perspective, it's really, really good opportunity, and it's in our top 5 for the small company fund.
Yeah, it's just into the top 5. Yeah. I think given how cheap it looks,
we talked about it at the start of the month.
Yeah.
Well, we just have to buy more. It's too good.
And like just speaking to a couple of there's a couple of contacts in the sports betting industry, they reckon the technology stack for Pointsbet is really good relative to competitors.
Love that. So,
given that it's now quite hard to get a gambling or sports betting license as well, there's also a takeover angle. Stake, which is being the big US betting and cryptocurrency betting player, not the discount show
Aussie broker.
Yeah.
They've just gone substantial recently, and have been vocal that they want to enter Australia, so you can see where this is going.
At 170 mil market cap, you'd think that that's quite an easy little, I'll have that, thanks for coming. So they could pay 300 for that, no blink. So
we think there's a few ways you can win with PointsBet, and the quarterly looked really good.
Yeah, upgraded their numbers again. And the other thing as well is, speaking of calls, the main reason we do listen to calls is we want to see what the other Muppets know. And and Ben got off the call. I said, what do they know? Which is always what I don't care about what the management said. I said, I want to know what everyone else knows. And he said, they ask the dumbest questions and they don't know anything. And
I don't know. I said, don't disrespect to the analysts out there. I think there was only 2 questions, and both of them didn't really hit the
mark.
The key thesis points.
So we don't think there's a lot of people on this. So kind of why we like it. So look, I mean, TB, there is broker coverage, and look, I don't know if there's not that many, but there is.
Yeah,
it is covered,
but it's more of an afterthought because they covered it when they were raising a lot of money back in the heady days. It's
probably got a junior on it, it's not really where you're going to be allocating resources if you're running a research department. So because there's no dollars there for you to chase. So look, we think PointsBet's a peach and good report, and going really well and probably going to make a lot of money for us.
Cool. Just from a quick glance, it looks like 150, 160 mil market cap. So it's definitely in the realms of small cap land and prime time for you guys, the Seneca. So that you did mention another company which is probably a favorite of investors, which is Credit Corp.
Yeah.
Purchase debt ledgers and related style businesses. Can you tell us, maybe start off with, for folks that don't know what it is and why you liked it?
All right. So when Ben hasn't paid his credit card for 19 months in a row, bank's sick of chasing him for the money. They'll often sell his $10,000 worth of credit card debt to someone like Credit Corp for $4,000.
Yep.
The bank will take the $4,000 and write off the rest, and then Credit Corp will buy it for $4,000 and try and collect $7,000 from Ben, and make the $3,000. And that's what a private debt ledger or a PDL is. Big bucket of these loans, and debt collectors like Credit Corp, they buy them for cents on the dollar, and they try and generate a return, in Credit Corp's case, of 20 to 30% on those buys after costs. So it's a really good business to be in, but it's got a couple of drivers that have been impacted, and the first is you need debts to buy. So you're supply constrained by the amount of bad debt that's out there, and by the same token, you're constrained by how much in terms of revenue, in terms of can you actually collect on that debt. And obviously, when debts are higher, the chance of collection might go down. So it's really about your skill and ability as a business to collect. So that's kind of why we like Credit Corp. They've got a really good track record for collections and buying really well. That is, being able to pick the eyes out of these debt ledgers and go, yeah, we want this one, but we don't want that one. And because we're going to get good collections there, but we're not going to get good collections there. And then they've spent a lot of money and time over the last decade, really, in streamlining, systemizing, offshoring a lot of what they do to generate better returns. But the management team are by nature very conservative, in my opinion. Maybe they would correct me, but I think they are. And certainly during COVID, they raised money and, really were over provisioning and held a lot of cash and didn't want to buy. And look, I don't actually necessarily blame them, because, it's easy now. Everyone's a genius in hindsight, but, at the time, who knows? They could have had, collections, bad debts blow out and really blown up their balance sheet and done all the wrong things. So I don't necessarily blame them, but essentially COVID kind of stuffed this business for a while from a returns perspective, and the earnings pretty much have followed that share price chart from 2020 onwards, right? That's sort of, they recovered a bit, but then they've kind of just drifted down and sideways with some, a few issues in the US, and Australia's kind of always sort of ticked along. It's a mature business here, but their incremental game's been in the US. So they reported, and whilst the report itself wasn't, anything to write home about, it's pretty solid, like, don't get me wrong, but really the guidance statement around debt ledger buying, expected returns, provisions, recoveries, all these things, everything's looking good now for Credit Corp, particularly in the US. So all of the macro data from our perspective for the last 3 to 6 months has been supportive of that sort of narrative that Credit Corp have then confirmed at their latest result. So for us, the ducks are lining up here. Now, does that guarantee that Credit Corp is back to generating 20% return on equity and is going to steadily grow, every year? Well, it doesn't mean it's going to happen tomorrow, but what it does mean is you're still buying this business at 10-year low valuations or near enough, right? So we want to own that company at those prices, and then over the next 2 to 4 halves, kind of watch that business hopefully exceed its former highs in terms of business performance, and I suspect on the back of that the share price will follow. So that's kind of something for us that's been an underperforming business, I suppose. And we've had relatively low weights in it, and then we've really juiced up the weights over the last 3 months on the back of this pretty strong data from some of the US peers.
Yeah, I think it's a good example when we talk about how do you prepare for reporting season. Just looking through my inbox here, and we actually did work on it 24th of May, looking at the peers and the peer reports, which we're actually tracking a lot better than the Credit Corp share price would suggest. So I think just like doing the work beforehand, getting all the available data, like, yeah, it's not a guarantee that you'll get the call right on the result day, but if you can, get 60% chance, like that's still, can be a big help. So,
two things. One is I'm still hung up on how Ben would have incurred a $10,000 phone bill to Luke's example.
I'm only winding him up. Really.
That's a lot of international roaming, is what I'd say. And the other thing,
well, these days up.
The other thing is, you're right. Like the share price is like, it's like, other than that COVID blip, which is like momentary, it really hasn't been down to these levels since like 2016. And this is a business that, if you went back pre-COVID, was like an all-star, right? Like
I'll get Ben to send you the stuff from our work, the charts from our work, but essentially, it's on one of the lowest PEs it's been on, and the earnings are actually now pretty much back in a trend of up and to the right. So the market hasn't reacted, even though the share price is up like 10, 15%. The market actually hasn't reacted to, well, fully priced in what's actually we think is likely already occurring and has to a degree occurred already in this business. And I think they're the sort of things that everybody wants to be 100% right all the time. And if you want to be 100% right all the time, you'll never make any money.
Yeah. So this is Credit Corp. CCP is the ticker symbol. And you guys hold it, right?
We own it.
Yes. Did you have one more winner for us? I felt like there was one more.
We've got one more for you.
Yeah, one we can talk about.
Go for it. Yeah, we love winners.
Yeah, winners.
No, I don't reckon anyone. None of the Rask community will buy this one.
No, that's why I'm hesitant. But
okay. Try it on, and everyone can let us know. They can send us an email or
pretty good.
Send you an email maybe. Just jump in the community and let us know. But what is it? Go for it.
Stanmore Resources, SMR.
Oh, okay.
It's a steel-making coke and coal producer in Queensland, the Bowen Basin, which is, one of the premier supply jurisdictions globally. Stanmore basically bought some unwanted mines off BHP in 2021. And then the coal price went through the roof with a lot of Russian supply disrupted. And particularly for the types of coals that Stanmore's producing, being that PCI coal. I won't get too technical. It's more Luke's area of expertise.
I was about to ask him what PCI stands for, but I don't want to make him look stupid on the call.
I know. It's straight to the steel for pulverized coal. No, so bought these mines for US $1.7 billion, I think was the total consideration. And they were able to pay that back through profits and cash flow in a year and a half. So that's a great return on any investment. But the beauty here is that these are long life,
20-year plus asset,
reasonable quality assets. Yeah. So, you've got that continued production, which it yields 11% free cash flow, and only trades on 8 times PE for this year's earnings. And they've also got these growth projects. So they've just recently acquired Eagle Downs off South 32 and others. So you can see the trend here. They're picking up BHP's mines, picking up South 32's mines. And look, we'll see who's the winner. But I think if history tells you anything, it's good to be on the other side of M&A with those kind of players. So yeah, it's one that we think is a lot cheaper than peers in a good sector. And yeah,
it's just dumb. Like it is because of the reason this trade exists for them, and I'm not talking about the trade to buy shares in Stanmore Coal. I'm talking about the fact that Stanmore Coal can go around acquiring great assets at ridiculously low prices and generate insane returns on invested capital for shareholders is because, one, the guy running the business is really good at M&A, and that's Marcelo Matos. He's actually my old boss from Vale. And
shout out, Marcelo.
And he's really good at buying stuff and really good at transacting. He's a M&A guy. That's what his DNA is. And then two, I think, all of the government approvals for new mines, even though this is steel making coal and there is no alternative, we need to mine it. If you want to keep making roads and houses, you need steel. Well, guess what? You need coke and coal to make coke, and you need coke to make steel. And there's only, one thing that does it. It's this stuff. So I think that, while we might have this aversion to coal mining because of thermal coal, the reality is that steelmaking coal is going to be here for a long time still to come. And I think there's no approvals, there's no one exploring, there's no capital for it. And so therefore the market's just going to be structurally undersupplied forever. And in the interim, these businesses, there's companies like BHP who are going green, or want to divest these assets because it feels bad on their, annual report to say that they're mining coal, and everyone gives them a hard. Australian Super say we can't be a shareholder unless you don't invest in coal, even though there's nothing unenvironmental about, metallurgical coal. It just means that these companies just have a huge advantage, and they can just run around buying up stuff, generating huge returns, and no one's there to stop them.
Cool. So that's Stanmore.
Yeah.
SMR. If you own it, reach out to Luke or Ben. There's a link in your show notes. But also, Luke, you are now obliged to get us in contact with Marcelo. Did you say it was?
Yeah, we can organize that.
Yeah. Get him on.
Marcelo would be happy to come on Rask and talk to the punters.
Yeah. Give us a connection so we can get him on and find out how he goes about buying these things. It'd be awesome. My final thing is kind of like as we come full circle, we talked about the top of the show. People can reach out and send us company ideas of reporting season. It's going to be a very busy month. There's obviously already some volatility that seems to be completely unrelated to fundamentals of businesses, and some shares are getting sold off. Some have bounced back. And that's a lot of that is at the top end of the town. But folks, if you're listening or watching and you like this, like pick the brains of these two gents. They'll be back on next week. But what can folks look forward to? Like, we may cover some of these companies in detail as the reports unfold, Ben. What is on the watch list for the next week, let's say? Maybe next 2 weeks.
Yeah, so next probably 2 weeks is where a lot of the action's starting to happen. On Friday this week, REA, realestate.com. I think that's always an interesting one. We always look at that together.
It's the best read of any company on the ASX, I think.
Why is that?
It's just the Australian property market is like the cornerstone of so much stuff, and listings and bounced on your spot here, but listings. It's just really interesting to me. Get some good data out of it. It's kind of like AFG where the home data comes out and they have all the stats, and they give you quite a lot. So the appendix of the REA report is always interesting.
Yep. And some good read-throughs there, even for a company that we do own, PEXA, which is also in the same property space, but looking at not the start of the property purchasing journey, but the end, doing the conveyancing. So that'll be an interesting read-through for that result. On Wednesday next week, Lifestyle Communities, LIC. That one I'm really looking forward to. Because if you pull up the 1 year chart on, so this was another one which is a March darling,
47%,
and it's run into some real issues. They do these retirement communities, and it's come to light in the media that some of their practices in terms of how they're charging these retirees, whacking them with a deferred management fee, things like that,
aren't really industry standard, shall we say?
Aren't industry standard. And they've just done an emergency equity raising, $275 million relative to that $1 billion market cap.
Just quite large. They did that
February. I assume it was Goldman Sachs, given they cover it. Why? What?
I just had an idea, but
I can't say that.
Take that off there.
And they withdrew all forward guidance 3 weeks ago. So
this is a hot. I mean, look, I'm not trying to be funny here. And I say this is a very high quality business and has been for a long time. Like, if you ran numbers to the end of 2024, to the end of 2023. I'm sorry. Forget about share price for a minute. Just go look at the business. The operating metrics are great, right?
Because it's been able to recycle capital.
It's so good at recycling capital and redeploying at higher and higher rates of return. So this is a really, really, really important example of when you can do desktop analysis on a business and you think you understand it and you're really good at doing spreadsheets and you're really good at looking at numbers and you spend all your time, in the weeds, but you don't actually know how a company operates. And, we like this sector. We actually think we own Ingenia, which is like a peer. but we own it for different reasons. And I think this is where, as a retail investor, you would think, okay, well, I'm going to go with the blue chip number one player in the space, Lifestyle Communities. But it's kind of one of those ones where if you haven't done your homework, you're going to get caught with your pants down here.
Mm. Okay. So that's Lifestyle Communities, LIC. Unfortunate ticker symbol, I might say, because it makes people think it's like a listed investment company.
I would change the name of the company if I was them, but that's just me.
You would what, sorry?
I'd change it to,
something else.
Start another code.
Yeah, for sure. Anything else, Ben, that's on your watch list?
There's plenty going on. I'm sure we could talk for... Can you do it too long? But last one, Pro Medicus.
Have to do it.
Pro Medicus, here we go. You know where you are. Go for it.
Yeah, I know it's one that you kind of cover on, but it's one that there's always high expectations priced in. Oh, what a beautiful share price chart that is. Goldman Sachs is forecasting 28% revenue growth and 29% EBITDA growth for this year. It trades on 120 times forward PE.
I think where we're going here, Owen.
And I just think, looking at Audinate, you see what happens if these high price stocks miss expectations. Not that I actually don't have a strong view how they'll report.
I'm putting an orange flag in it.
Orange flag.
Orange flag in the PME result. I think it could do well on the day. This is full art here, so don't take punters. You might do okay on the day, and then get a bunch of whole downgrades on the back of it. Or if there is even the semblance of neutrality, not like ramping success, but just a semblance of neutrality in the guidance statement or in the management tone on the call, look out. That's all I'm saying. Look out. This thing could be down 15, 20% like that. And that's kind of I'm not saying it's going to happen. I'm just saying be aware.
Interesting. I think you're underestimating You're underestimating the appeal of that 0.28% yield, my friend. This is a yield plus growth stock.
Fully franked, Joel?
Fully franked.
It'll have to be fully franked, so therefore you can bump that up.
Find out. I've got that and Wise. Is Wise Tech next week?
I think so.
Yeah, we've got Wise Tech on my
watch.
Orange flag watch now.
We know how much you love Wise Tech because you're on the show last time talking about different accounting and roll-up accounting of international subsidiaries and yada, yada, yada.
I prefer Pro Medicus to Wise Tech. It's a great business.
Yeah, I agree.
Great people.
Stellar job. But I'm not having... I think if Pro Medicus went down... a bit, I would definitely be looking at it for sure. Whereas Wise Tech, I reckon, could get cut in half and you still have a hard time convincing me to buy it.
Interesting.
So now that's just my, I shouldn't say it's our preferences on how we like to invest. I'm not saying that people haven't been successful owning Wise Tech, like it's kicked ass, right? So, but we're wrong here. But I think you don't pay us to be invested in everything. You pay us to invest the way that we think's best. And if it doesn't, we've got to have the courage of our convictions and stick to our knitting, because if we just started chasing everything that was going up, we'd end up with a really shit portfolio. So but I would have there's two market darlings that I would have orange flags in, and I'd be paying very, 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 if I'm a big shareholder in those, I'd be paying very, very, very close attention to those results and any pre-result trading. So like whatever happens the day before, if they underperform the day before, if I was a shareholder, I'd be sketching.
Okay.
It's just, man, it's just, I just feel that it's just got a bit of frothing, and that's real art. That's the art version, the science version. So don't quote me, but if we're not here to just be number jockeys, and we're here to give you an opinion, and that's my opinion.
Okay, no, that's fair, and thank you for that. So folks can look you up, get in contact. There is a link in the show notes to book in a call with you guys. It's totally free. And if you are an investor, it's obviously not something that you should just jump on and chat with Luke or Ben for the sake of it. If you're serious and you like what Seneca do, get in contact with the guys and get an opinion on some companies or just chat to them about ideas. If not, we'll be back next week and we'll be doing more of this. So send in your comments, your feedback, particularly if we see a nice big green flag from Pro Medicus. Let's rally around it. Let's get the troops going. Full disclosure, I still own a very small amount of Pro Medicus shares, and I'm very happy. And every time I see like a $125 share price, I just think, oh my Lord. I started selling at $13. So yeah, that's a long way ago.
It's a long way ago now.
Yeah.
But it's been a great call of yours. Like,
yeah. Cheers, mate. It's once for a lifetime so far. So thanks, guys. It's been heaps of fun. Put all the links in the show notes to what we reference, as well as the back catalogue of potties. So really appreciate you guys joining me.
Pleasure. Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.